So you want to buy a toll road. Not build one, buy one, an actual working highway that already has cars on it every single day. Here's the part that should sound impossible. In 2005, the city of Chicago sold a 7.8-mile stretch of elevated road for $1.83 billion, a price 50 times what the road was actually earning that year. Investors lined up to pay it anyway. 11 years later, they sold it again for $2.8 billion. 6 years after that, a slice of it changed hands again at a valuation north of $3 billion. Same road, no new lanes, no new traffic. Just 3 sets of owners, each one paying more than the last for the right to collect tolls on a bridge most Chicagoans drive over without a second thought. That's the trick you're buying into. A toll road isn't really a piece of concrete. It's a 75 to 99-year contract that behaves like a bond, prints cash like a monopoly, and can also bankrupt the smartest infrastructure investors in the world if you get one clause wrong. Toll roads come in 3 tiers, and the price gap between them is enormous. At the top is the state-level megalease, the kind that made headlines. The Chicago Skyway went first in 2005, a joint venture between Spain's Sintra and Australia's Macquarie Group, paying that $1.83 billion for a 99-year lease. A year later, the same consortium leased the 157-mile Indiana Toll Road for 75 years, this time for $3.8 billion, nearly $1 billion more than the next closest bid. Below that sits the regional concession tier, river crossings, urban bypasses, managed lanes, typically costing hundreds of millions rather than billions, and carrying much higher risk because there's no decades-long traffic history to lean on. And at the very top of the market are the international mega concessions, where governments don't lease single roads, they lease entire national networks. France handed its autoroute system to conglomerates like Vinci-backed ASF and Eiffage, concessions that run into the 2030s and generate the kind of predictable cash flow that underpins publicly traded parent companies. In 2024, a European consortium of Ferrovial, Acciona and Satsaya won a $3.4 billion greenfield ring road concession in Lima, Peru. Proof the market never stopped growing, it just went global. Getting the concession in the first place is its own multi-year gauntlet. Governments run it like a formal auction. First an expression of interest to gauge who's even paying attention, then a request for qualifications to weed out anyone without the balance sheet to survive a mega project, then a request for proposals where the finalists submit binding bids built on decades of projected traffic, toll escalation, and a discounted cash flow model. Whoever can raise the cheapest, longest debt and accept the thinnest equity return usually wins. That's not always a compliment, it's also exactly how you end up overpaying. And once you've won, the day one bill starts immediately, long before a single extra car uses the road. France's autoroute operators don't just collect tolls, they're contractually obligated to keep funding capital expenditure and maintenance through integrated subsidiaries like Eurovia and Freycinet, with the state levying heavy financial penalties for underinvestment. On a megalease like the Skyway or the Indiana Toll Road, the operator inherits every life cycle liability for the life of the contract: resurfacing, structural inspections, snow removal, tolling technology upgrades, none of which shows up in the headline purchase price, all of which gets underwritten into the financing from day one. The asset looks like a single upfront check. In practice, it's a 75 to 99-year maintenance obligation with a check attached. Here's the part almost nobody outside project finance has ever heard explained. A toll road doesn't actually have one business model. It has 3, and which one you're operating under determines almost everything about your risk, your financing cost, and whether you go bankrupt. The first is the real toll, the obvious one, where drivers pay you directly at the gantry. You take on all the traffic risk and all the revenue risk, but you also keep all the upside if the region booms, and most real toll contracts come with built-in inflation escalators. The Skyway and the Indiana Toll Road both run on real tolls. The second is the shadow toll, a mechanism invented specifically so a government can build a free road for voters while secretly paying a private operator per vehicle out of the treasury, using a banding formula that caps the payout as volumes rise. The UK pioneered it in the 1990s. Portugal adopted it aggressively for its SCUT highway network, marketed literally as no cost to the user. Then came the 2011 debt crisis, and Portugal discovered its shadow toll liabilities had ballooned to an estimated €48 billion, running through 2049, worth roughly 30% of the entire country's GDP at the time. Free roads aren't free. Someone's treasury is paying per car, and because drivers never see a price, nobody restrains demand, so the bill just grows until the state has to publicly break its own promise and retrofit real tolls onto roads it swore would stay free. The third model, and the one governments overwhelmingly prefer now for new construction, is the availability payment. The government pays the operator a fixed annual fee for keeping the road open and maintained to spec. Full stop. Empty road, full payment. Gridlocked road, the operator still doesn't see a cent of the upside because the government keeps any tolls it chooses to levy. The operator's only real risk is performance. Miss your snow-clearing deadline or let the pavement degrade, and the penalty gets deducted straight from your check. Debt syndicates love this structure because it turns a volatile, traffic-dependent equity play into something that behaves like a government bond, which means cheaper financing, which means more competitive bids. It's the default choice now for any greenfield project where nobody can honestly predict what traffic will look like in year 1, let alone year 20. Even once you've picked your payment model, the deal only survives if you're protected from the one thing that can kill a toll road overnight: the government building a free road next to yours. That's why concession contracts came loaded with non-compete clauses, and no case shows what happens when that clause actually gets enforced better than California's State Route 91. Lenders treat these clauses as non-negotiable. Without one, project finance models simply refuse to pencil out because no bank wants to underwrite 30 years of debt against a road a future governor could render worthless with a single ribbon cutting. In 1989, Caltrans let a private company called CPTC build 10 miles of express toll lanes down the median of SR 91, connecting booming Riverside County to job-rich Orange County. To secure financing for the $135 million build, the state agreed to a 1.5-mile no-build protection zone along both sides of the corridor, locked in through 2030. It worked exactly as designed for about 3 years. Then the region's population exploded. The free lanes turned into some of the worst gridlock in the entire country, and Caltrans was legally forbidden from adding so much as a safety lane to relieve it, because doing so would have violated the contract with the company profiting from that exact congestion. The public eventually figured out the operator had every incentive to keep the free lanes miserable, since misery is what pushed drivers into the toll lanes. The state tried to legislate its way out twice and failed both times. In the end, Orange County's Transportation Authority simply bought the whole franchise back in 2003 for $207.5 million, nearly 54% more than it cost to build the thing in the first place, just to make the non-compete clause disappear. Every modern concession contract since has been rewritten because of that one deal. Governments retain the right to build competing roads now, but only if they're willing to compensate the private operator for provable revenue loss. The names attached to this business are the same names you'd expect: sovereign wealth funds and pension plans, not individual buyers. But the individuals who structure the deals still get remembered, for better or worse. Chicago's original architects on the Skyway deal have projected the lease's equity value could compound past $15 billion by the time it reverts to the city near the end of this century. A road that cost $1.83 billion up front, worth potentially 8 times that before it's even handed back. That's the aspirational version of this business. Buy right, hold for decades, let inflation escalators and pension fund patience do the rest. And you don't even need to hold it that long to profit. The Skyway's owners have never waited passively for that terminal value. Atlas Arteria, the current majority stakeholder, has guided investors to 40 cents per security in distributions for both 2025 and 2026, explicitly funded by capital releases pulled straight out of the Skyway and the French APRR network's cash flow, years before either concession is anywhere near its expiry. The genius of a 99-year lease isn't just the payout at the end. It's refinancing the thing every decade or so and pulling your original investment back out in cash while you still own the asset generating it. Then there's the cautionary version, and it's the same road type, the same era, practically the same buyer. In 2005, Indiana's Governor Mitch Daniels pushed through a 75-year lease of the Indiana Toll Road to the same Sintra-Macquarie consortium behind the Skyway for $3.8 billion, nearly twice what the state's own consultants thought the lease was worth. To make the math work, the consortium built its financing on a 9-year interest-only bullet loan, hedged with a 20-year accreting interest rate swap that locked in rates climbing from 3% up to 11.3% by 2023. The plan was simple: Ride an assumed 22% every 7 years traffic growth curve. Refinance before the rates got ugly. Then 2008 happened. Commercial trucking collapsed. Traffic fell by roughly 42% instead of climbing, and the Federal Reserve crashed interest rates to near zero, which, because of how the swap was structured, triggered massive mark-to-market losses that nearly doubled the total project debt from $3.4 billion to $6 billion by 2011. Refinancing became mathematically impossible. In September 2014, the concession company filed for Chapter 11. Here's the twist that actually matters for anyone thinking about buying into this asset class. The state of Indiana didn't lose a dime. It had already banked the full $3.8 billion years earlier and spent it on 87 road projects and 60 new interchanges without issuing new public debt. The highway itself never stopped running. Tolls kept getting collected, snow kept getting plowed, while the private equity sponsors watched their entire investment get wiped out in bankruptcy court. In March 2015, a fresh 66-year lease went to IFM Investors, an infrastructure fund backed by 30 pension funds, for $5.725 billion, structured far more conservatively. By early 2024, that same highway was generating over $109 million in quarterly EBITDA on $129.8 million in toll revenue. Nothing was wrong with the road. Everything was wrong with the financial engineering wrapped around it. That's the pattern across every toll road bankruptcy in this business. The asset survives, the capital structure doesn't. San Diego's South Bay Expressway filed Chapter 11 in March 2010 after flawed traffic projections collided with the financial crisis. South Carolina's Southern Connector filed the same year for the same reason. Nobody drove on it the way the model said they would. In both cases, the physical road stayed open to the public. The equity sponsors got wiped out, the senior lenders took a haircut, new owners bought in at a fraction of the original build cost, and the highway kept collecting tolls like nothing happened. A toll road, unlike a casino or a restaurant, basically cannot go out of business. Only its owners can. Both failures share the same root cause as Indiana's. A greenfield road, built with no historical traffic data to anchor the model, financed on the winning bidder's most optimistic possible traffic curve rather than the most realistic one. In a competitive auction, the operator who wins is very often the operator who was simply the most wrong about the future in the most convenient direction, a phenomenon project finance people call the winner's curse, and it shows up in this industry more reliably than almost any other. Time to pull it all together and answer the actual question. How much money do you make if you do this right? Option 1. A regional concession. A bridge, a bypass, a managed lane project, hundreds of millions rather than billions to build or acquire. Margins here vary wildly by traffic pattern. Virginia's Dulles Greenway posted 8.2% traffic growth and 7.3% revenue growth in 2025 on steady local commuter demand, while Germany's Warnow Tunnel, a smaller regional crossing, saw traffic drop 3% the same year from local roadworks, even as revenue still edged up 1.6%. Regional assets are lower cost to enter but far more exposed to whatever's happening on that one specific stretch of pavement. Option 2. The Interstate Mega Lease. A road like the Chicago Skyway or the Indiana Toll Road, billions to acquire, EBITDA margins running well above 70% once the debt structure is sane. Atlas Arteria's whole portfolio posted a 75% proportional EBITDA margin in 2025, $1.509 billion in EBITDA on $2.012 billion in revenue. The Skyway posted a 6.2% jump in toll revenue in 2025, even with traffic essentially flat, purely off contractual price escalation, and by the second quarter of 2026, that revenue growth was running at 6.2% again, this time backed by a genuine 4.7% jump in traffic. France's APRR network, a comparable interstate-scale asset, ran similar numbers, 1.3% traffic growth translating into 2.8% revenue growth. This is the tier where the cash flow behaves like a bond, and the payback isn't measured in years, it's measured in decades of compounding lease value. Option 3. The small cross-border or niche regional route, where inelastic demand can produce the best margins in the entire industry. The Adalat concession linking southeastern France to Geneva posted an 86.4% EBITDA margin in 2025, 67.2 million euros in EBITDA on just 77.6 million euros in revenue, because commuters crossing that specific border have no real alternative and never will. Across every tier, the mechanism is the same. You're not selling transportation, you're selling the absence of a choice, locked into a contract that outlives the people who signed it, collecting a small toll on every single person who has nowhere else to go. The building never depreciates the way a casino or a car dealership does. The customer base never needs marketing, and the only real threat to the business model is a government that changes its mind, which is exactly why every modern concession contract is now built, clause by clause, to make sure that never happens for free.